If you don't find a way to make money while you sleep, you will work until you die. Once said by Warren Buffett. It's like a warning or advice, but it's authentic. I will show you that Warren Buffett's strategies aren't just for picking stocks. What if the real secret behind his success isn't about the stock market at all, but about buying businesses, evaluating companies, and understanding their real worth? Warren Buffett, one of the richest investors in history, has a simple rule. The stock market is a device for transferring money from the impatient to the patient. Think about that for a second. The market is designed to reward those who wait and punish those who panic. But what does that really mean? How does it work? And more importantly, how can you use this principle to build wealth, just like Buffett? If you're a business owner, if you're an entrepreneur, if you're an investor looking to acquire a company, Buffett's methods can help you understand what makes a business truly valuable. Today, we're breaking down the Warren Buffett mindset, his investment strategy, and the mistakes you must avoid if you ever want to succeed. Buffett's real strategy is business evaluation. He doesn't see stocks as just numbers fluctuating in the market. He sees them as pieces of real businesses, and he only buys when the price makes sense. But here's the important part. These principles aren't just for stocks. They are essential for anyone buying, selling, or running a business. Warren Buffett isn't just another billionaire investor. He's been making money in the market for over 70 years consistently. Not for 1 year, not for 5, but for decades. He started with just a few $1,000s, and today, he owns one of the most successful investment companies in the world. He said, "I am a better investor because I am a businessman, and a better businessman because I am an investor." Buffett has always said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. But this isn't about stocks. It's about owning businesses. Think about it. Would you buy a local bakery just because someone told you it might be worth more next month? Of course not. You'd look at revenue and profitability. How much money does it actually make? Competitive advantage. What makes it different? Why would customers stay loyal? Management quality. Who's running it? Can they grow the business? Debt and risk. Is it financially stable or drowning in liabilities? This is exactly how Buffett looks at companies. He doesn't buy stocks. He buys businesses. If a stock isn't worth owning as a business, he won't touch it. So, what makes him different? It all comes down to patience, discipline, and the ability to control emotions. And if you don't have these traits, the stock market will eat you alive. Let's dive into Buffett's legendary investment philosophy, the difference between an investor and a speculator, and why timing the market is the fastest way to lose your money. First, let's decode Buffett's famous quote, "Be fearful when others are greedy, and be greedy when others are fearful." What does that mean? It means that most people buy stocks when prices are rising and panic sell when prices fall. They follow the crowd. But Buffett? He does the opposite. When the market is crashing, when fear is at its peak, when everyone is running away, that's when he buys. Because he understands one thing that most people ignore. The stock market isn't just about stock prices. It's about real businesses. As Buffett said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Speculators focus on price movements. They try to time the market, guessing when stocks will go up or down. But Buffett? He doesn't care about short-term price swings. He cares about the value of a business. And here's the biggest mistake people make. They treat stocks like lottery tickets instead of ownership in real companies. Buffett follows a strategy inspired by his mentor, Benjamin Graham. He believes that stocks are ownership stakes in businesses, not just numbers on a screen. And that's why he doesn't panic when prices drop. Because if the business is strong, the price doesn't matter. Let's take a simple example. Imagine you own a restaurant that makes $100,000 in profit every year. Now, let's say one day, someone knocks on your door and says, "I'll buy your restaurant for $500,000. You'd probably say no. It's worth more than that. But what if the next day, another person offers you $50,000 for the same restaurant? Would you suddenly panic and sell it? No, because you know its real value. That's exactly how Buffett looks at stocks. He doesn't ask, "What's the stock price today?" He asks, "What's this business really worth?" And if the stock price is way lower than its actual value, he buys. This is called margin of safety, one of Buffett's key principles. It means buying a stock only when it's selling for much less than its true worth. That way, even if things go wrong, you're still protected. Climax, the most powerful takeaway. Now, here's where things get really interesting. Someone once asked Buffett, "What's your favorite holding period for a stock?" His answer? "Our favorite holding period is forever." Think about that. Most traders buy stocks for days or weeks, but Buffett buys stocks as if he's never going to sell them. Why? Because if you own a great business, why would you ever sell it? This is the complete opposite of how most people invest. They chase quick gains, jump in and out of stocks, and let their emotions drive their decisions. But Buffett? He ignores the noise. The more patient you are, the more money you make. As Buffett said, the stock market is a device for transferring money from the impatient to the patient. But most people can't do this. They see stock prices moving up and down every day, and they panic. That's why the market transfers money from the impatient to the patient. Let's recap Buffett's biggest investing lessons. Patience wins. The stock market rewards those who think long-term and punishes those who act on emotions. Invest, don't speculate. Stop trying to time the market. Focus on buying great businesses at good prices. Fear and greed control the market. If everyone is greedy, be cautious. If everyone is scared, look for opportunities. Always demand a margin of safety. Never overpay for a stock. Make sure you are getting real value. Stocks aren't lottery tickets. They represent real businesses. Treat them that way. These are the principles that made Warren Buffett a billionaire. And if you follow them, you won't just survive in the stock market, you'll thrive. Warren Buffett said, "You only have to do a very few things right in your life, so long as you don't do too many things wrong." Now, here's a question for you. Are you an investor or a speculator? Drop a comment below and let me know how you approach investing. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell, because we're bringing you more powerful insights on finance, investing, and wealth building and crowdfunding every single week.